Welcome to this afternoon's event, Preserving Worker Firm Attachments, Perspectives from the Pandemic. Thanks to those of you who are watching live, and thanks to everyone who will watch this video at their convenience at some point in the future. A reminder that video for the event will live on the webpage for this event, as well as on AEI's YouTube channel. I am Michael Strain, a senior fellow here at the American Enterprise Institute, and I'm delighted to welcome all of you. In a typical recession, there are economic benefits to business closure. While often disruptive and damaging to business owners and to employees, closure allows for a reallocation of labor and capital resources away from firms that aren't able to generate profits in a new economic environment. This process ultimately benefits the overall economy, including workers overall. The economic crisis triggered by the COVID-19 pandemic was of a different nature than a typical recession. Governments had intentionally restricted activity in significant parts of the economy in order to reduce the in-person interactions that might spread this novel virus. As a consequence of these restrictions, and as a consequence of individuals voluntarily choosing to limit their in-person interactions, businesses that were productive and profitable in February of 2020 were in grave danger of bankruptcy just a few weeks later. The threat of business closures in this instance did not reflect an inability of at-risk firms to compete in the market or to survive a period of depressed aggregate demand. Instead, the threat came from forced reductions in business activity of unknown duration and of severe intensity. This unique circumstance created the possibility of liquidations. For many businesses, the black box of production, consisting of organizational knowledge, robust customer and supplier networks, and importantly, worker firm links and the firm's specific human capital held by workers, was at risk of being shattered. These liquidations would have been wasteful because they did not result from market forces or factors. This logic was especially compelling in the spring of 2020, when the lockdowns were expected to be relatively short. Recognizing this unique set of circumstances, governments in advanced economies provided various types of support to aid businesses to ensure business continuity and to preserve worker firm links. These programs were often expensive, and some of them had complex rules. Even seemingly secondary aspects of the design of these programs involved allocating significant amounts of resources and could affect economic outcomes for years to come. Economists are only beginning to understand the economic effects of these programs. To further our knowledge of these programs, my colleague Stan Veuger and I thought to gather distinguished economists to study what we know about these different programs and to place what we know about them in one volume. One purpose of this event is to publicize that volume, which was just published. We thought that having papers about different countries' experiences in one volume would allow readers and scholars to compare and contrast the programs in ways that help illuminate what worked, what didn't, and why different countries made different choices, all with an eye towards policy lessons for the future. While we don't expect and certainly don't hope for another pandemic, we do think that lessons from these programs can benefit policymakers in the event of a future severe recession, regardless of its cause. Today's event features the authors of 4 of the chapters in this volume. Ian Schmutte is Associate Professor of Economics at the University of Georgia. His chapter provides a general overview of the value of employer-employee matches and the challenges associated with measuring their value. Juan Francisco Jimeno is an advisor to the Bank of Spain. His chapter studies Spain's short-time work program, which allowed, among other features, for temporary layoffs and which incorporated financial incentives for employers to reactivate workers. Jennifer Hunt is Professor of Economics at Rutgers University. Dr. Hunt's chapter studies Australia's JobKeeper program, which provided a wage subsidy to employers with significant revenue losses. And Ricardo Reis is A.W. Phillips Professor of Economics at the London School of Economics. His chapter places these programs in an important context by addressing their cost and by addressing the fiscal position of the countries in which they were adopted. In addition to these 4 chapters, the volume has chapters on programs in Canada, France, Germany, Italy, the Netherlands, and the UK. You can find a link to the volume on the webpage for this event. The run of show for this event will be straightforward. After I am done with this rather lengthy introduction, I will hand the mic over to my colleague Stan Veuger, who will then invite each author to present on his or her chapter. Following those presentations, we will have a moderated discussion along with questions from the audience. Please submit your questions to my colleague John Toohey by email. His email address is john.toohey@aei.org. You can find the spelling on the webpage for this event. You're also welcome to submit questions via Twitter using the hashtag AskAEIEcon. That's hashtag AskAEIEcon. Today's event is part of the Edward and Helen Hintz book forums at AEI. These forums provide a platform to host authors for discussions of books on issues of national and international significance. We are very grateful to Edward and Helen for their support of AEI and for their commitment to our mission. Before turning the mic over to my colleague Stan Veuger, I will introduce him. Stan is a senior fellow and an economist here at the American Enterprise Institute. Let me thank again everybody for tuning in. Let me preemptively thank our 4 distinguished panelists, and let me thank Dr. Veuger. Stan, take it away.
Thank you very much, Mike, for that lengthy introduction. I think you've done a pretty good job introducing our various speakers here as well. So I'm just going to go ahead and ask Ian Schmutte to open the event by talking about his chapter on the value of employee links. Ian, take it away. Thank you.
All right, thanks, Stan. Yeah, I'd like to thank Mike and Stan both for including this chapter in the volume and inviting me here today to discuss it. I should mention I feel a little bit guilty because when Mike first emailed me about writing this chapter, he asked specifically for a chapter where I could talk about sort of measured variation in the value of employer-employee matches and how quickly that match value might deteriorate. I think with the idea of providing some specific policy guidance about which matches are worth preserving. That chapter turned out to be impossible to write given the state of the literature and certainly what I know. So instead, I wrote something more broad and conceptual that I hope can help guide the way towards being able to ultimately answer those kinds of questions. So I'm just going to spend my time here today to give an overview of what that chapter is about and why I hope it proves to be useful as a contribution to this literature and to these discussions. So the chapter starts with a basic premise that I think Mike kind of summarized in his lengthy introduction. If you think about the pandemic as a natural disaster that had sort of suddenly required the economy to be turned off in some sense, but without changing the inherent productivity of underlying relationships. Another way to think about that is 2 kinds of things happen in a recession. Ordinarily, a bunch of jobs are destroyed, often for efficiency enhancing reasons, and then workers get kicked out of those jobs. So the perspective I tried to adopt in the chapter is, what if instead you have a situation where workers get kicked out of jobs, but those jobs are in some abstract sense still valuable? What do you gain from minimizing the need to refill those jobs again? And starting out writing the chapter, I was and remain very skeptical of arguments that were particularly prevalent in spring and summer of 2020, that low-wage jobs or jobs that require few specialized skills can sort of easily be refilled. And so the value in preserving employer-employee links might be low or negligible amongst those types of jobs. In fact, it appears that employers struggle to fill all kinds of jobs, including high-wage, low-wage jobs all the time and for all kinds of reasons. So the chapter advances 3 arguments about match value and associated evidence. First is that there's evidence for the United States, but also for other countries, of a substantial amount of match-specific capital in employment relationships that might be hard to rebuild. The second is that this high match value is not indeed not limited to jobs with these specialized skills, to workers, say, that have rare skills, or jobs that are in highly productive firms. And finally, in recessions that are driven by something like a natural disaster, policies that focus on preserving match value can be very much worth pursuing, even though they may impede the reallocation of labor. So in terms of the first argument, I'm going to recognize that inefficient match destruction is always possible. And so in the chapter, I return to arguments that I think are familiar to many labor economists, and that come out of 1999 handbook chapter by Hank Farber. The labor economists typically define match value is how much better off both parties to the match are, i.e. the employer and the worker, by staying in the match relative to their next best option. And so in that sense, matches can blow up if either party gets a better option. For example, a worker getting a better outside offer, or to a productivity shock, the way that we typically think about it, like a firm suddenly finding that it can't sell its output at the same price. Neither of these things can happen, even when the total value of the match still remains better than all of the feasible alternatives. And so short-time work policies, I think of the type we'll hear more about today, are premised on the idea that destroying job matches because a firm is facing some temporary hardship may often be inefficient. We also have a significant amount of evidence on the value of matches, and that match value can be quite prevalent. So as recently as 2018 in the United States, over 40% of college-educated workers between 35 and 65, so prime age workers, had been in their jobs for more than 10 years, and 15% had been in their jobs for more than 20 years. And so we know, again, going back to this long literature, the existence of match surplus tends to imply that jobs should be long-lasting. So the fact that we continue to see relatively quite long tenure jobs, it provides some evidence of the prevalence and indeed wide extent of match surplus. Furthermore, to find those good matches, workers move across many jobs, and we can see this in data from the quarterly workforce indicators, and this is true particularly amongst workers early in their careers. There's plenty of evidence that firms find workers very hard to replace with new hires, including in some of my own work using data both from the United States, Denmark, and Brazil. And a long literature also showing that workers tend to suffer long-lasting lifetime earnings losses when their jobs are suddenly destroyed. So all of this evidence indicates both that match value appears to be prevalent. Firms find employment relationships relatively difficult to build, and that these facts are true up and down the earnings and skill distribution. So in thinking about this, in the chapter, I conclude with some suggestions for research, and the idea is really to grab a little bit from everywhere. We have a literature that documents the extent to which firms tend to share profits with workers, which provides one direct approach to at least measuring the extent of labor productivity and the way that firms and workers bargain over what is some kind of measure of surplus in the employment relationship. Furthermore, structural models focused on assortative matching can provide sharp predictions on the distribution of match value and the consequences of destroying and preserving matches under different policies. And finally, we can think about evaluating policies directly in terms of their effects on match quality. And there's a long history of this in evaluations of unemployment insurance, which tend to focus exactly on the trade-off between longer unemployment spells potentially leading to better matches versus longer unemployment spells. So to conclude, my discussion of match value in the chapter started from the premise of a pandemic in which we sort of put the economy on pause, but in reality, that's not what happened at all. Instead, has been pointed out by many others, the pandemic was also a reallocation shock. And my own research on the Danish experience suggests that furlough policies may not have impeded reallocation very much, but that's still not quite clear. Unfortunately, I think more events like the pandemic may well lay in the future. And so we need both more theoretical and empirical social science to help direct policy in the event that that happens. So thanks again for the opportunity to discuss my chapter. That's the end of my comments.
Thank you so much, Ian. We'll all have an opportunity to comment on your chapter and ask some questions after the various presentations. But now we're going to go to hear about two of the country-specific experiences. And first, I'm going to ask Jennifer Hunt to talk about what unfolded in Australia. Please go ahead.
Thank you very much. It's a pleasure to be able to tell you about Australia. And this is work with my co-author, Jeff Borland, from the University of Melbourne. So first, to understand the Australian experience, you have to understand its unusual COVID experience. So these are daily COVID cases from March 2020 to June 2021. And this up here, that's the US and Germany. And then this line here, that's Australia. That's a log scale. So you can see that there's 1/100th of the cases in Australia. The blue one is New Zealand. So there was an initial wave here and then a second wave. And the economic downturn all comes in this first wave. And so here, this gives you an idea of what happened to GDP in Australia compared to the US. So here in this purple line, it said nothing much had happened in the first quarter of 2020 in Australia, unlike the US. And then GDP fell about 7%, so less than the US. And then by the end of 2020, GDP had actually recovered, which was not the case yet in the US. So relatively speaking, a smaller economic shock than some countries, particularly the US. And the main labor market program that was developed was this so-called JobKeeper program, JobKeeper in one word. And it was announced on the 30th of March, 2020. And its aims were to provide financial support to workers to ensure the viability of businesses, and central for this conference today, to preserve connections between employers and employees. The program announced on the 30th of March, it was announced at that time that to be a program running from April to September. And it was aimed at firms anticipating large revenue losses, and the definition of it depended on the firm size. And it was actually a very simple program, really, in that the benefits were simply that through the employer, each worker who'd been on the payroll on the 1st of March received 750 Australian dollars per week, even if that was more than what they'd earned before. And if a firm applied for JobKeeper, they had to use this subsidy for all their workers. In Australian dollar, the exchange rate fluctuates, but multiply by about 0.7 to get US dollars. And in fact, for all of September, April to September, 27 to 29% of all workers are defined as people who'd been employed initially, were receiving JobKeeper. And then as COVID didn't go away and there was a second wave, the program was extended through March 2021, this time eligibility for firms being based on actual revenue losses in the recent past. And the key thing for this paper and meeting is to talk about workers, and I put that in quotes, who were receiving JobKeeper but not working any hours. So if you had been on the payroll on the 1st of March, even if you actually stopped working at the request of the firm, you would still receive the $750 per week. And that $750 was higher than the flat rate unemployment benefit. So in Australia, the unemployment benefit is not a percent of wages. And confusingly, at least to people used to American statistics and law, these people working 0 hours actually count as employed, both statistically and legally in Australia. And the point of this whole thing, of course, was that the hope was to maintain the employer-employee connection, which should presumably then lead to a faster recovery from the downturn. Just very briefly, there were a lot of other things going on at the same time. There were tax cuts, there were loans to businesses, there were direct subsidies to some sectors like airlines, there was debt restructuring, and cumulatively through June 2021, this amounted to 17.5% of GDP, along with JobKeeper, compared to the US, even higher, in fact, at 22.2%. So we're interested in the degree to which JobKeeper saved jobs through what one in the US would consider a temporary layoff system. So that's not all that JobKeeper did, because it subsidized workers who are working positive hours. But we're most interested here in those who worked no hours, and the hope was that they would be recalled to the same employer. So the definition of saving a job in this way, the first condition would be that the person was not permanently laid off, that they were temporarily laid off. So in this context, it means put on JobKeeper, but that they were also recalled to the job. So our paper here differs a little from some other work that was done earlier that didn't actually look to see if these people were recalled to the jobs. But if they weren't recalled, the job wasn't really saved in our view. And what was actually the incentive for the employer to temporarily lay off instead of permanently? There was no cost to the employer in fact, there was savings for a worker working no hours, there was no cost and no savings to putting the worker onto JobKeeper, in other words, laying them off temporarily. But if they failed to recall the worker, that would count, in fact, as a dismissal. In Australia, there are costs associated with dismissals. The employer has to pay various payments to the worker. So this cost of not recalling was not directly associated with the JobKeeper, but it's just part of the law that they've been considered employed until recalled. And if they weren't recalled, then the dismissal process had to be gone through. Now, the data a little bit hit or miss in Australia. And my co-author and I, know from the data if somebody's on a temporary layoff, but we don't know if they're also receiving JobKeeper. But the Australian Treasury had somewhat better data that we don't have direct access to, and we use both public data and the Treasury data. So let's just look at some labor market statistics first. So if you look at the official unemployment rate, which is this, you can see how nice it is for the government to have those people on temporary layoffs defined as employed, because the unemployment rate only went up from 5.5% to 7.5%. But if you count those people who are not working any hours and are receiving JobKeeper as actually unemployed, then you see there was a big increase to 12%. And then notice, though, that went away by November 2020. Well, the two have converged. They're not quite back to normal. Actually, that took longer. Now, in this graph, we can see, first of all, what happened to employment as defined by the Australian government. So that's this black line. So as defined by the Australian government, employment fell about not even 7%. But from a US perspective, we would be more used to defining it by the red line, including people on 0 hours as temporary layoffs being non-employed. Okay, so that's the red, which is basically the same as the light blue line, which is monthly hours worked. And so that fell 10% in 1 month. That's in 1 month. And then sort of stagnated a little bit. And then there's already a strong recovery in the third month And then it continues until things are pretty much back to normal by the end of 2020. So focusing more directly now on the workers on, we'll just say temporary layoff, because although we believe that with the exception of 1 point in this graph, these people are also receiving JobKeeper, we actually don't know that for sure. So these are the numbers of workers identified in the labor force survey as being on temporary layoff, and the y-axis is in thousands. So you start off here before anything happens in Australia in March with 76,000 people, and it leaps up to 770,000. But there's an oddity to those who's used to US statistics, that if you were recently permanently laid off, that you show up in the temporary layoff category. And so these people here, we actually can see that many of them leave the labor force after that. So they're not entirely, then they're not neither unemployed nor employed by US standards. So a better measure of the peak of people who are actually on temporary layoff is here just before the recovery began. And that number is 368,000. And so a very simple measure of the number of jobs saved if you based it merely on the downturn in the economy would be 368,000 minus the usual number of 76,000, or maybe for some reason these 76,000 didn't actually occur, and so the real number is 368,000. So if you do subtract off the normal number, you'll get about 300,000 people as having been on JobKeeper temporary layoff, and that's about 2.2% of pre-COVID employment. And remember that measured in the US way, it fell 10%. So not a huge amount, but definitely worth having, a tiny bit more if you didn't subtract off the 76,000. But we don't want to stop there, because this doesn't ask the question of whether these people were ever recalled. So it's nice if they had this benefit for a while, but if they didn't get their job back, we wouldn't consider that job to have been saved via the mechanism of temporary layoffs. So let's look at the first few months of COVID and see what the stocks of employed people were doing. That's so this bar here, that's the big decline in employment in the first month, April 2020. And then you can see how it's split up. Again, this is artificially inflated in this year. This is the number of people that are on temporary layoffs, but that one's artificially inflated. This is the number of people leaving the labor force. And then in part because of the definition of actually unemployed people, that doesn't change very much. Then May, if you recall, was a sort of a transition year, and the month. And there is, in fact, some decline in the stock of people on temporary layoff there. And then June is the big recovery here. So this is where you see, because these things all sort of cancel out, so employment's not changing much. Then in June, there actually is a significant recovery in employment. And you can see that it actually mostly comes from people who moved from out of the labor force to employment, or who seem to. These are just the stocks. And there's actually not much going on here with the reduction in people on temporary layoff. And then if you take the next 2 months, there's really nothing going on. And the next few months, also almost nothing going on. And so it's really coming, most of the recovery is coming from people who were out of the labor force. So this bar here, so this is the first month of the recovery, and we're interested in knowing now numerically, like what proportion of that increase in employment came from that decline in people on temporary layoff. Well, 136,000 people left temporary layoff status in that first recovery month, June. And from other data published by Treasury, we know that we do have transition matrices, and we know about 1/4 of them actually transitioned to non-employment. So the recalls in that first month of the recovery we're only about 3/4 of 136,000 or 100,000 people, which is only 0.8% of pre-COVID employment compared to the 10% decline. And it also implies that only about a little bit more than a third of the temporarily laid off workers were in fact recalled immediately. That's actually about the very first month. But we're interested in the first month because that's precisely when this connection should allow people quickly to be recalled. Now, data that we don't have direct access to from Treasury in the first several months suggested that, but using information on JobKeeper, suggested there are about 140,000 recalls in the first several months. So again, that's consistent with our impression that 0.8%, maybe 1% of pre-COVID employment was involved in recalls when the upturn began. So in conclusion, measured the US way, employment fell 10%, and recalls in the first upturn month were only 0.8% of pre-COVID employment. Only a little bit more than a third of people who were put on temporary layoff, presumably through this program, were immediately recalled, which suggests that JobKeeper didn't really either speed the recovery very much nor save many jobs. Thank you very much.
Thank you. Thank you so much, Jennifer. From Australia, we're going to go all the way to Spain. Juan Francisco Jimeno is joining us. Thank you for taking the time, especially because I think in 28 minutes, Liverpool's playing Real Madrid, and so you'll miss out on the first bit of that. But thank you again, and please go ahead.
Yes, good afternoon. Thank you, Stan and Michael, for inviting me to contribute to this volume, and also thank you for inviting me to talk about my chapter in this event. I must say that I am a strong supporter of Real Madrid, so I'll be very nervous through the event. So my chapter was about Spain, and the main purpose of the chapter was to compare the Spanish experience with job rotation schemes as a response to the pandemic. So in the chapter, basically, I do three things. I describe the institutions, labor market institutions in Spain, and how these institutions were changed during the pandemic. I provide some statistical description on the use of job rotation schemes in Spain, and then I draw some conclusion about to what extent these measures were efficient to sustain employment and were the adequate response to the COVID-19 crisis. Okay, so I am already explained very well why labor hoarding and keeping the match between employers and employees might be the adequate response to this type of crisis, and why policies to facilitate keeping these links and to facilitate labor hoarding was the right way to go. And in fact, in many OECD countries, we saw an increasing use of these types of policies. Okay. What is peculiar in the Spanish case? Well, there are 5 elements that make the Spanish case an interesting case to study. Okay. First, as many of you know, the Spanish labor market has a very strong dual nature, where there are 75% of permanent employees. These are employees very much protected from dismissals, and 25% temporary employees. So the problem with the job retention scheme was the unequal coverage and unequal protection for these two types of workers. And what we saw during the pandemic is that permanent workers were very much protected from dismissals and obtain even increased unemployment benefits, while temporary workers were less protected. The second point is that the composition of employment in Spain was very unfit for continuing activity, for continuing employment and working using teleworking. Spain has a strong bias towards elementary occupations, sectors with where presence is required to provide the service, like hotels and restaurants, arts and many other sectors. And for that reason, there was not possible to cope with this within increasing teleworking to the extent that it was possible in other countries. On top of that, the confinement that we have from March to June in 2020 was very, very strict, much stricter than in other European countries. So the only possibility for continuing being employed was teleworking. So given these conditions, it's not surprising to see that the job rotation schemes in Spain were very much used during the first phase of the pandemic. Okay? And then two other important points to note about how job rotation schemes were used in Spain was that through the whole period, the changes were agreed between the government and the social partners, trade unions and employer representatives. Anytime that a change was introduced in the legislation and how the job rotation schemes were designed, this was agreed by the three partners. And there were sequential negotiations adapting job rotation scheme conditions to the evolution of the pandemic. So that the extent and the possibility of using these schemes were changing from March 2020 to December 2021, and the reinstatement of workers was also negotiated and gradually designed during this period. As I said, I will be more precise on this in a moment, but this type of job rotation scheme is like a temporary layoff with an employment insurance, but keeping the employment relationship. So as Jennifer presented on the Australian case, these people under these schemes were not counted as an employee. They kept the employment relationship. And even on top of that, they got increased employment protection legislation, because during the one condition to use job rotation scheme for firms was to keep workers, to not to fire any worker during a period after the end of the job rotation scheme.
Juan, while you're paused, can I say your slides are not advancing? I think it's because you went into full screen before you shared your screen. I know you're coming up to some graphs, so before you do, I think you'll have to unshare, go to not full screen, then share, and then go to full screen.
Okay, you are seeing the contents slide?
We're still seeing the title slide.
Okay, sorry. Oh, sorry about that. This was working before, so I don't know why.
Well, the problem, of course, is that you're not using Mr. Gates's outstanding suite of Office applications.
Okay, that's good. We can see it now. That's good.
Okay, good. So this was the slide I was commenting on. So the peculiarities of the Spanish case, and then what I will conclude with some comments about the efficiency of this job rotation scheme as a policy response to the pandemic. So I have some graphs showing you what I said before, that the composition of employment, either by sectors of activity or by occupations, in the Spanish case, is biased towards jobs in which physical presence is required. So there is the red bar is Spain, the other bars are United States, United Kingdom, Italy, Germany, and France. So there is low weight of high digital intensive industries, high weight of arts, entertainments, and other services, low weight of public administration, high weight of trade and hotel and restaurants, and low weight of energy. And by looking at occupations, elementary occupations are high in Spain, while you see managers, professionals, and other occupation where teleworking is more feasible, they have a low weight. Okay? And not surprising, working from home is not. It was used in Spain during the pandemic. You see, the 2020 bar is almost 10% of employees were working from home, but it's much lower than in countries like Germany, France, or Italy. And the occupied persons that did not work, well, during the first phase of the pandemic, up to 14% of people were considered occupied, were counted as employed, but they were not working. And they were not working because they were covered by these job rotation schemes that, in fact, existed in Spain well before the pandemic, but they were not very much used as an instrument to adjust labor force by the firms. Okay? Basically, what job rotation schemes are, which in Spain they are called ERTE, is basically, as Jennifer explained, just temporary layoff, but with the employment relationship still in effect. So workers get unemployment benefits while these job rotation schemes are in effect. The job rotation scheme could be either by suspending employment relationship or by reducing working hours. And firms, the advantage for firms is that they don't have to pay dismissal costs, they don't have to pay fine costs, and in some cases, they get a rebate in Social Security contribution. They don't pay Social Security contribution while the ERTE is in effect. Okay? So this was used in Spain to a minor extent before the pandemic. What happened during the pandemic is that the government allowed for a huge flexibilization and extension of ERTEs, so that they define new justified causes to implement ERTEs by relating these causes to the confinement measures or to the state of alert or to restriction to the operation of economic activity during the pandemic. They extended the unemployment benefits that workers get during these ERTEs, and they try to help firms to reinstate the workers after the confinement with some incentives in Social Security contribution, okay? Some rebates in Social Security contribution. The counterpart for firms is that during this period, while the firms were using ERTEs, they could not fire workers. They were further restriction on firings that, as I said, in Spain, in the case of permanent workers, these firing restrictions are very, very strict. Okay, so a few numbers you see there. the peak the use of ERTEs during the pandemic, the suspension of the employment relationship affected to 3.5% of the labor force during the second quarter of 2020. Then there was some gradual restatement and a little increase at the beginning of 2021, but it was minor and very transitory. And as you see, the use of sector was higher in services than in manufacturing and services. Regarding reduction of working hours, 25% of workers got some kind of reduction of working hours during the second quarter of 2020, and this was subsidized with partial unemployment benefits, so that in total, almost 30% of workers were covered by these job retention schemes. Okay? So this was, as I said, the main instrument to support firms and workers during the pandemic. On top of that, we have direct transfer to firms as in other countries, but the amount of these transfers in the Spanish case was much, much lower. Okay? So let me conclude. As I said, this kind of crisis was the perfect example for why labor hoarding and temporary layoffs could be an effective response. And in fact, government, firms, and workers could find common grounds to implement this type of job rotation schemes, which are especially attractive, are especially good measures in countries like Spain, where you have high firing costs and inefficient job matching, precisely because of this dual structure of the labor market. Okay? Before the pandemic, and for European countries, there was evidence supporting the view that short-time job retention scheme save jobs at lower cost than other employment policies. There are papers by Pierre Cauc on the French case showing precisely this. What we learned during the pandemic is that if you look at the aggregates, if you look at employment and unemployment, this was very efficient sustaining employment, while in the Great Recession in Spain, the unemployment rate increased by 8-10 percentage points. During this crisis, the COVID-19 crisis, the increase in the unemployment rate was just 1 percentage point. Okay? So if you look at the aggregate, you might conclude that this was a successful policy. Still, as Ian also said, I think it's too early to tell. There are forthcoming micro studies on how the employment and the wage profiles of workers were affected by job retention schemes. And here, the evidence we are seeing is not so positive. And also, there are likely costs in the implementation of these schemes, like deadweight losses, both in the take-up of job rotation schemes and in the incentive for the gradual reinstatement of workers. In the Spanish case, there were not many incentives for training during the layoffs, and of course, the possibility of delaying reallocation is also a concern. Okay. In any case, the view of many politicians in Spain and many economists is that this was a successful experience. And in fact, the new labor market reform that we have in 2021, you know that we in Spain are very good at two things: One is football, soccer, as you call it, and the other one is reforming the labor market. We have been reforming the labor market over and over again. Well, the last one, incorporate job rotation scheme as a main instrument for cyclical and structural adjustment of the labor force, for sector in crisis, and so on. So the mood is that this was a good experience, and it's worthwhile to incorporate this as a permanent instrument, and not only for crises like the COVID-19 crisis. And that's all. Sorry for the mistake at the beginning with the slides, but
no worries at all. I didn't intervene immediately because I wasn't sure if you had slides for your original verbal comments, but I think Jennifer intervened exactly when the need was highest.
okay.
With that, we're going to go to Ricardo, who's going to talk about fiscal constraints, in particular in the U.S. during the pandemic, because of course the U.S. had a very expensive, costly program meant to preserve employee links. Ricardo, please go ahead.
Terrific, thank you. And just to double check, you are seeing my slides go up and down, yes?
Yes, for sure.
Perfect. Okay, great. So thank you so much for inviting me to this event, as well as, of course, to contribute this brief chapter to this really wonderful book. My focus is going to be in the US, although really a lot of the things that I'm going to say apply across Australia, Spain, and many of the other countries covered in the book. Because the question I want to ask is, having heard the three wonderful previous presentations on how it was useful in some regards to engage in some government programs in order to alleviate the enormous stress that COVID-19 and the pandemic put on the economy, and dealing with, as you saw, in a very thoughtful way with the previous authors, of which of those policies may have worked a little better, which ones may have worked a little worse. A question arises that as we look at the package of these policies, to what extent can we afford to implement them, insofar as, for the most part, they cost some money during a pandemic, which then has to be borrowed during that time or during that crisis and paid off later. And the common observation across the US, Spain, Australia, and other countries is that governments were able to borrow very large amounts in order to implement thoughtful and maybe less thoughtful programs during that crisis. And the question I want to ask is, how is that possible? How could they borrow so much without really much of a glitch? Before that, allow me to spend 1 or 2 minutes on a little bit of the history of public debt in the US, although again, I want to focus on the US just for concreteness, but this could be true of other countries. It used to be that the path of public debt, going back, and one could go back all the way to the 19th century, followed a little bit of a seesaw, which World War II illustrates very acutely. You would borrow a gigantic amount to fight for freedom, and then for the 20 or 30 years after, you would pay for it gradually. Sometimes these jumps up were shorter and the payment would happen faster, but you always saw the seesaw type phenomenon. That meant that holding public debt was a very safe proposition, both because the two major sources of risk for someone who lends to the government are that inflation eats away your debt. Well, the gold standard made sure that wouldn't happen, certainly in the 19th century. And the fact that you'd have deficits that, even if large, were short-lived, meant that you would have a significant extent of surpluses paying for that. After around 1960, though, and I guess I should have expanded this graph even more, you see a remarkable change in the behavior of debt across all countries, including the United States. Again, one could date it 1960, one could date it probably 1980, but let me tell you why 1960 ends up being perhaps, or around the 1960s, ends up being a key turning point. First, government budgets start being dominated by expenses associated with the welfare state, health, retirement, and so on, and income support programs, which are much harder to, after a big ramp up, slow down. And so it becomes very hard to generate surpluses, at least in a very quick way. Second, we have a large period, of course, of inflation in the United States in the 1970s that meant that counting on government bonds to always pay you whole in real terms after inflation stop being something you could take as given. And third, as a result of choice of policies, you start having that both when one has a Republican or a Democrat in the administration, paying down the debt becomes a priority that's permanently delayed. And as a result, debt rises, and rises. Now, as that debt rises, it is important to note that even before COVID, debt had already been rising in the United States with essentially no gap or no interruption since 2000. Indeed, the current 21st century description of debt dynamics is not of a seesaw, rather it is of constant debt, a crisis come along and you jump up, constant debt, a crisis come along and you jump up. More of a ladder than a seesaw. In fact, the IMF at the end of the crisis was forecast that public debt across all economies would essentially be constant. Nothing of the seesaw, nothing of paying down the debt for the next 5, 6, 7 years. That's a very different type of debt dynamics. It is in this context that we reach the pandemic. And during the pandemic, there was very good reasons, as were explained by Michael in the introduction here, for why we needed to run deficits. It was definitely not the right time to raise tax rates, even as tax revenues were collapsing. It was definitely the right time to provide some stimulus to the economy, even as firms could not reach out to consumers who were locked in their homes. And there was extremely good reasons, for very much the reasons mentioned by the previous, by Ian, Jennifer, and Juan Francisco, of providing social insurance in the sense of, with its asymmetric impacts, allowing for flexibility in jobs and flexibility and ability of reallocation in the economy through government programs that would cost some. However, quite interestingly, what we saw in the data is that those who spend the most were not those who had less debt, but rather those that had more debt to start with before the pandemic. That is, in implementing these worthwhile public programs, there was a sense that there was no such thing as debt capacity. You might have expected that those who entered the pandemic with a very large debt, of course, say Japan at the entrance, at the head of the line, would be the ones that were therefore able to spend less. And so to have a strong negative relation here. And yet the relation is either positive or either zero or actually positive. It is those countries that had more debt to start with that were spending more. How can that be? We want to have these programs implemented, but at least the extent to which you can afford them, let's say, you would think might depend on the debt that you had coming in. The answer in the case of the United States can be given in a somewhat, let me say, mechanical way before going a little deeper into understanding it. During the pandemic, the reason why the United States was able to spend so much extra and borrow that amount, even though it entered the recession already with a very large debt, was that there were a lot of people, almost tautologically, willing to lend to the US government. Who were those people? Again, almost mechanically, those people were all the Americans who were locked at home, unable to leave it to go and spend their money, and who therefore saved it by keeping it in their banks. Those banks, in turn, rushed to deposit it at the Federal Reserve, that extra money, and that extra money, in turn, was used by the Federal Reserve to buy government bonds and thus to borrow to the government. So in a pure accounting sense, we had excess savings during the pandemic. Those excess savings were then channeled through the banks, through the Federal Reserve, to the government as a form of lending. And lo and behold, we're able to borrow a gigantic amount without this being much of an issue, because the same people that needed help also were, or not the same people, but certainly Americans as well, were willing to save by lending to the government. Moving forward, though, is the lesson here that there's no such thing as a limit to public borrowing? And my very clear answer in this chapter is a big resounding no. And I say this with this force because I understand how it's tempting to draw the conclusion. And I certainly see here on the other side of the Atlantic how that is really affecting the way public policies are set. There has been quite of an energy crisis in the side of the Atlantic, and governments from Spain, but also Germany and Holland, have engaged in massive deficits in 2022 and going on to 2023. In other words, just 2 years after an emergency required massive deficits, here we are in massive deficit land yet again. Now, again, there are good reasons to do some extra spending this time, but so near to the last massive spending that happened and massive deficits that happened, and with the public debt at record high levels in countries like France and Germany, what you have is a perception by the policymakers that we can just keep on borrowing without a problem. And this is especially noticeable over the last 12 months here. But I might also add, certainly in the US, with the IRA and different policy packages, paying down the debt seems to be very down the list of priorities. And so why is it that worries me, that disregard for any limits to public borrowing? It is the law of accounting that the increase in the public debt is driven by three terms. One, primary deficits. Second, by the required return on the debt by investors who want to get those who are willing to lend to the government, as well as to generally lend those savers and the return that they require to save. And the third term, which a recent literature is called the debt revenue term. The debt revenue term arises because the return paid on the public debt is well below the return on private investments, the return on, if you want, savings overall. Because of that gap, that means the government gets a discount when it borrows relative to other borrowers in the economy. That means that its debt grows at a slower rate. That means that it saves future taxes to repay a debt that grows at a lower rate. This can even be realized insofar as if the government is borrowing at a lower rate, it can go and lend to the firms or to the job protection program that Juan Francisco was mentioning at a higher rate, the private rate, and in doing so make an immediate revenue. But more generally, it's just implicit insofar as by running all of these deficits, we are ultimately having a debt. And after paying down, raising taxes in the future to pay for it, we will have money left over, this debt revenue, because the interest rates on government debt were so low. It has always been the case that the United States enjoyed, on average over the last 150 years, of paying on its public debt less than pretty much any borrower in the US economy. But what has changed is that over the last 20 years, the gap between this return that we observed in public markets, which has been very stable, and the return that the US government is asked to pay to its borrowers, that gap has increased quite substantially. In other words, the discount that the government gets in public borrowing has increased quite significantly. And with that discount comes a revenue, comes a source of revenue, comes an ability to expand the debt massively over 20 years, while the payments on that debt do not grow. Where does this specialness of public debt arise? The literature has advanced at least four very broad arguments for why this gap exists. Government debt provides relative safety insofar as governments are more often, or certainly the US government is always ready to pay back its debt, unlike some private investments. Government debt is especially liquid, and that safety may have increased for after the great financial crisis, we became more and more aware of the risks of lending in private markets. Government debt is very liquid, very easy to sell, something again became even more present after the financial crisis, especially with all the increases in regulation requiring so many investors to hold liquid assets. Government debt is very good as collateral if you want to engage in transactions around the world. And government debt is a very good desired store of value by foreigners that want a safe haven for their savings. All of these reasons have increased, and with it, as the debt revenue increased, such that if you look at the debt, and if you ask the question, how do we pay for the rising debt? We paid it by selling the service debt provided, by having this debt revenue term, which is red minus blue here, increase every year in the last 20 years as the demand rose across the world for US treasuries. However, having understood how this was possible also opens our eyes to why this has limits. And I want to highlight two limits here. And I highlight two limits in my, I highlight three limits, but I thought with the time, I'll only have time to mention two. The first one is that what allowed this debt revenue, what allowed the specialness of debt, what allowed us to increase debt so much in the last 20 plus years was in great part the fact that we had very stable inflation, that price stability was a given. Why? Because that keeps the main source of risk on the debt very low. An independent inflation targeting central bank is the best way to maximize debt revenue because it guarantees that the major risk of debt not paying back as much as you wanted will disappear. In 2022, we had actually significant amount of debt in the United States because we had a lot of inflation. That inflation inflated away the debt by as much as 50%. Indeed, we're running no surpluses and yet the debt has fallen. That is a one-off gain that now over the next 10 years will come instead with losses from a high inflation risk premium that shrinks the debt revenue term. So as one sees government rejoicing in the US with the fall of government debt, it's important to realize that all of that comes from inflating away bondholders. The same bondholders will now require higher returns to hold the government debt in the next 10 years, will shrink the debt revenue and make the debt less sustainable. Indeed, it is a danger, even in the short run, if one were to have a central bank delaying raising rates to keep that revenue high without realizing that would be eroding its long-run specialness, which is so important to preserve. So the debt revenue will likely shrink in the next 10 years, and it is absolutely crucial that the Federal Reserve is able to stabilize inflation sooner rather than later if we are to keep at least some of it. The second limit is that one needs some fiscal caution. Again, as I told you, fiscal responses were very large and much larger during COVID across not just advanced economies, but the other economies than in previous crises. But it is important to understand that you can borrow while people think you are safe. The US has enjoyed, even more than any other country, the fact that when one goes into crisis, it benefits from the specialness of the debt becoming even higher. However, we had in 2020 problems in the Treasury debt market, and we have right now yet another version of debt limit ceilings or debt ceilings and difficulties in Congress in keeping a smooth operation of the Treasury market. That leads one to worry about some of the loss of the debt revenue. Moreover, the existence of a debt revenue justifies having very aggressive deficits during crisis. Why? Because during crisis, the specialness of the debt increases. But it also justifies paying debts faster once a crisis is over. And that is something that we are not seeing any appetite happening. Moreover, public debt or maximizing that revenue is important to note, is not maximizing social welfare. Namely, financial developments that allow for more private investment will crowd out savings that used to be going to public debt will now go to private investment. And that is a good thing. That is how growth happens through private investment. If we have a private investment boom in the next few years, and I sure hope we will, in order to boost our growth and productivity, that will necessarily imply a pressure on debt revenues, which I hope financial repression will not come in order to maintain. To conclude, the increase in public borrowing in 2020 was not a one-off, but a culmination of a long trend where we respond to crisis ever more aggressively and do not pay for that debt during non-crisis time. The reason why we're able to do it is because we had an increasing gap between the return on private investments and the return on public debt. As the value of the specialness of debt, public debt as a store of value, safety, collateral, liquidity, had risen partly in response to the great financial crisis, but partly also because of other trends. But this fiscal capacity should be not taken for granted and will likely be shrinking in the next 10 years, which was why reinforcing commitment to price stability is an urgent policy priority, as is to have the fiscal rectitude of having surpluses in non-crisis time. The first one, I trust, is happening right now with the National Federal Reserve, but the latter one is one that I hope gets reintroduced in the economic policy debate. Thank you very much.
Thank you so much, Ricardo, and thanks everyone for really doing a really good job on the time. Right, we have about 20 minutes left for comments and questions. I wanted to start out with sort of two broad questions for all four of you, and if you don't have thoughts on this, feel free to not answer. But I wanted to first ask. So, looking back now on these programs, do you think sort of broadly speaking, because a lot of OECD countries had very similar policies they implemented in the first months of the recession. Do you think they were a good set of policies? Do you think they were worth the money? Do you think other ways of spending the money would have been more productive? Direct payments like the US did extensively, unemployment insurance. You could have spent more money on retraining. All kinds of things you could have done. So if you look at it sort of broadly speaking across the OECD or in the specific country you focused your chapter on, do you think this was a reasonable set of policies? Do you think we really made big mistakes there? May have been understandable mistakes in the heat of the first months of the pandemic, but were they big mistakes? Jennifer, you want to go first?
So the Australian policy was done in a rush and was achieved a lot of its aims, not the particular one we're talking about here concerning recalls, but at a huge price per job saved. And in that, it resembles the US, although at least it was done in a much, much simpler way. And actually the cost per job was about half even the US number, even though it's far too high. And so I think that, there's a good reason why those policies were wasteful. It's because if you're doing them in a rush, they're going to end up being wasteful. You have to get the money out the door quickly. And so the key thing is to have a policy in advance, as Juan was saying. And in my view, because actually I have spent a lot of time studying Germany, in my view, the short-time work policy, which Juan mentioned was also in place in Germany, is the best one to have. It's a policy you have in place permanently and can be used by individual firms even when there isn't a recession. And it involves having the employer agree to reduce the hours of either all or a whole unit within the firm. And then if, let's say, unemployment benefits replace 2/3 of the earnings, then the same is true for short time. It's only replacing 2/3 of half the earnings instead of all the earnings. And so I'm a big admirer of that policy. And I think it does rely to some degree, though, on it being expensive to fire people. I think the reason it hasn't taken off in the US, I was involved a little bit with it when I was at the Department of Labor after the previous recession. And the reason it doesn't work so well in the US is that it's pretty costless just to lay people off entirely. And that is true in Australia as well, though. So Australia should be in good shape to introduce this, but with the complication, though, that the unemployment is not insurance, actually. It's an unemployment flat rate benefit. So you can't sort of seamlessly introduce this, use the same percentage for short-time work as for unemployment. But I think that more countries should try to either introduce or streamline their short-time programs.
Juan, you want to go?
Yeah, no, I mostly agree with Jennifer. I think in the Spanish case, given that we have these instruments, it was the natural way of responding to the crisis, because with this instrument you achieve two important goals for this transitory shock. One is to provide income support to workers without the complexity of direct transfers and so on. And secondly, you keep the employment relationship between employers and employees. And this was, again, natural in the case of transitory shock that was perceived as something that would last for only a few months. So at the beginning, it was natural to respond this way. Of course, there were mistakes in the implementation of ERTEs in Spain. There were mistakes in the way they were extended to particular sectors. There were mistakes restricting firings and covering not all workers, but only workers with permanent contracts. There were mistakes in the incentive for the gradual reinstatement of workers to work once the confinement was over. But overall, and with the concerns that I mentioned before about deadweight losses, delaying reallocation, and so on, overall, I think it was a good policy. It provided the two things that were needed at that time: income support and support for employment and for firms.
So I would add, I would add that, I mean, the different perspective that also came from my chapter is, one thing is, were these good policies in comparison with others? So a composition of the policy package. A separate question, which I'll try to answer to complement the previous answers, is the size of the package. I think, as you saw, there was enormous cross-country variation in how big these packages were. Enormous. With the US standing out as one of the ones that spend the most. Now, if you look at the depth of the recession in the US, or just generally how well it handled it, I think it's hard to argue that the US did much better in outcomes. So certainly the US seems, let's say, inefficient insofar as it spent a lot more to basically get the same bang, to get the same result. Now, that is not a fair comparison, because maybe in the case of the US, it required spending more given the characteristics of how the US economy was hit by COVID. So this is not in any way definite proof. But I think that when one looks back, and I think it will take a few years to look back and evaluate, I think the composition will come into question, but also just the absolute size and magnitude of the packages and whether they were too big. And on that point, Stan, I think it's important.
Sorry,
and on that point, I would just let me add the one sentence is that, and on that point, and again, just given my chapter, as let us not all forget that it's looking at the benefits of a particular public policy at the time is a wonderful thing to do, but one must look at the costs in the future of raising taxes to pay for that policy. And all of this debt has to be paid for with taxes that will be distortionary and will be difficult for Americans and others to pay. And so that's where the size, I think, becomes, and that's where the requirement for this to be an efficient mix, I think, becomes present. We haven't seen that for the reasons that I discussed, but taxes are going to be higher in order to pay for some of these things.
So Ricardo,
we can also pay for some of it by inflating it away,
which, as I said, is a one-off solution that will actually make it more expensive for you to pay than over the next. Ricardo, can I ask a quick follow-up? Do you think the perception of the size of the U.S. package is more positive than it would have been without the war in Ukraine? Because you probably would have seen a larger inflation differential between the U.S. and Europe. Do you think that makes the size of the U.S. package look wiser than it really was in comparison? I think the point you made is a plausible one. Again, it's hard to quantify that, but it's certainly the case that the size of the U.S. package was most analysis of the current inflation increase of the last 18 months. When they look at the U.S., see certainly a very large role for the deficits, which in Europe, while present, is not quite as high because you also have the supply side. So I think there's some truth to that. Quantifying exactly how much it is or not, I think, is a little bit harder to say. Mike, you were, I don't know if I could chew off there.
I was just making a joke about inflation.
Yeah, well, that's fair enough. So that's looking back. Now looking forward, to what extent do you think these policies should and will play a role, to the extent that they were new, in dealing with sort of normal recessions moving forward? It sounds like certainly Jennifer, maybe Juan Francisco as well, reasonably positive about short work programs. I think Ian sounded pretty skeptical, certainly, about attempting to preserve the employer-employee links of lower wage workers. Is part of the issue whether you are in a country with where firing workers is very expensive, where hiring workers is expensive? Does that maybe explain some of the divide in which policies are in place in continental Europe versus the broad Anglosphere? What are your thoughts on that moving forward? Did we learn something particularly valuable from this pandemic experience, or is it just exceptional and not clear what we can do with it in normal times?
Well, as I said in my presentation, now these schemes are part of the normal policy for normal recessions in Spain. No? And so it's the increasing role of these schemes in adjusting the.
And you think that's good, or you think that's bad?
I can't hear you, but
sorry, I was saying, do you think? I know they. So now they're a part of the regular process. Do you think that's good, or do you think that's bad, or do you?
No, of course, it depends on the type of recession you are facing. Obviously, this was a very bad policy if it were implemented during the Great Recession, for instance, where in the cases of Spain, we needed huge reallocation of labor for the construction sector to other sectors. So when you have the need for this reallocation of labor, this is not a good policy. Also, I agree with Ricardo, is very expensive. The deficit in the Spanish unemployment insurance system in 2020 was 12 billions. 12 billions is almost 1% of GDP. It was just a very huge deficit in a system which was having surpluses of about 5 billion in previous years. So the deterioration of the public accounts on this front was 17 billion, which is a lot. But my reaction to Ricardo's comments would be, well, in that precise moment, given the extraordinary nature of the crisis that we have, I think it was required to do something like this. And I agree, the increase in the debt could have been very high, and we need to repay that debt as soon as possible. But I guess that we didn't have other options at that time than to increase the debt, to provide the income support, and to sustain employment at that time. But I fully agree that fiscal policy needs reconsideration after that, and that not many governments are doing it.
Very good. So, and again, a third, I know I'm taking up a lot of time here. A third question. So we've seen in many of the countries that are studied in the book, we've seen pretty significant labor shortages over the past year, 2 years. To what extent do you think these policies, which, you know, as the title of Juan's chapter indicates, incentivize labor hoarding, to what extent do you think these policies contributed to those labor shortages? Or do you really think that's more of a question just of, you know, super high demand and unrelated to these efforts to preserve ties? Is that something you've been concerned about? And I'm going to call on Mike or Ian unless someone starts talking.
I mean, you know, I think that in a general sense, you know, certainly in the United States, my view is that these programs have supported medium-term labor demand. And so, you know, if kind of a typical pattern is, you know, shock hits the economy, aggregate demand falls, firms go out of business, aggregate demand picks up, hiring at continuing firms picks up, new businesses are formed, hiring at new businesses picks up. You know, I think in the United States, we were able to kind of skip a couple of those steps, or at least to reduce the severity of those steps. And I think that likely did contribute to medium-term labor demand. I also think that, you know, these programs put money in the pockets of workers. And money in those pockets contributed to the demand for goods and services over the medium term, which also obviously contributes to labor demand. And so, you know, I think they had a kind of a general purpose effect of supporting a really strong and historically rapid recovery, while also having a direct effect of keeping more businesses afloat and supporting employment in those businesses. So in that sense, you know, I think, yes, I think that they contributed to an imbalance in the labor market between the supply of workers and the demand for workers. whether or not they kind of contributed to a labor shortage in kind of a negative sense, where a bunch of firms were kept afloat, that we'd probably be better off if they went under. Those firms are employing workers that would be better off working for other firms. That I don't think we know. I certainly don't have a sense one way or the other. I wouldn't even know how to speculate to offer an answer to that question at this point.
Okay. Yes, sorry, you can go ahead. Yeah,
that's okay. I was just going to offer, I guess, some speculation here as well. I mean, I think I agree with Mike in the sense that there seemed to be, multifaceted explanation for what's happened in terms of tight labor markets. It strikes me that given that we've seen this across many different countries, many different types of policies, that at least some significant part of labor shortages have had to do both with just withdrawal of labor supply for a variety of reasons stemming from the pandemic, and also changes in preferences for work, the kinds of reallocation effects that it's not clear exactly how persistent they're going to be, but they seem to have persisted for quite a while. So I think there's certainly a combination of supply side factors that may not be driven necessarily by policy, but by the pandemic itself.
Excellent. I have a question from the internet. Someone asked me, if 10 years from now, we're going to be looking back at this, which important questions about these programs, about this experience, will we be able to answer that we do not know the answer to now? So not, in a utopian world, I'm interpreting, what would you like to know about these programs? But what do you think we'll be able to learn 10 years from now? Obviously, that calls for speculation, but I think it's not a completely unreasonable question. Ian, you want to speculate first?
Sure. I mean, I would imagine that in the next 10 years, because these policies rolled out so quickly, it's kind of hard. So I've looked a bit at policies in Denmark and sort of in real time trying to evaluate what was happening. And even a couple of years later, it's hard to really parse out all of the implementation details and really use them to get a really clear handle on what some of the causal effects of different elements of the policies were. And so my guess would be even within 5 years, we'll start to get much better and cleaner evaluations of different components of these policies within different countries. And then this kind of international comparison will perhaps then be able to be conducted with even a bit more depth.
Ricardo, on the macro side, are there particular things that you think we will be able to learn, or is it all going to be complicated and the pandemic was happening at the same time?
Well, I think, yes, on the macro side, it's going to be a little bit difficult to disentangle the combination of many different shocks. But I would answer in a somewhat broader sense, which is broad and with apologies, because I'm going to be a little overgeneral. But I think at a somewhat overgeneral statement, we had at the macro level, two perspectives on what to do in a recession. One that said, was very Keynesian, that in a recession we should have public deficits to push up aggregate demand. Michael already mentioned it earlier. And one that was very, if you want, supply sider, which was we should have deficits in order to keep taxes down, or at least tax rates constant. And so there were two good reasons to run deficits, and those are the ones that we thought. I think this COVID, you could already say this happened in the global financial crisis, but also on COVID, I think has given rise to a third reason to run deficits in recessions, to a third role for fiscal policy at an aggregate level, and that is to provide social insurance ex post, if you want. So I guess I shouldn't call it insurance, but I don't have a better name. But social transfers ex post that complete markets that didn't exist before, that compensate, that prevent the breakdown of some relationships. You may ask, why did these insurance markets exist before? And the economists have certainly asked those, and I think there's very good reasons why they don't exist. But you now have a government that or a fiscal policy that comes in crisis as of, let's say, creating a set of transfers or that compensate for those missing insurance markets. Having seen that in the financial crisis across firms, having seen this now across households and others in this recession, I think in 10 years, we'll learn whether this is truly legitimately maybe the modern way to think about stabilization policy. That stabilization policy, automatic stabilizers, become much more about micro distributions, if you want, and less about agri demand or less about just tax disincentives during recessions. I think that could be a true big change. And I think the data, the studies already in this book start their work of understanding precisely whether that is a better way to think about what governments should do in recessions.
Fantastic. Ricardo, with that, we're out of time. Thank you again, both for your participation today and for your contributions to the edited volume, which, as Mike said, details of which you can find on the event page. You can order it. If you really don't want to pay for it, you can call me or send me an email, and I'll see what I can do for you. But with that, thanks again. Thanks to our audience, including our future audience, and everyone have a very good rest of your day.
Thank you.